Well, coming up on this episode of the Smart Mortgage Show, we're talking about ways to get your mortgage rate down. Everybody's trying to find the most competitive rate available. But does it matter if you put a larger down payment? Will that help you get a better rate? We'll discuss that today with Bill. Welcome in. This is the Smart Mortgage Show. I'm Ben George with Bill Litton, Regional President of Cross Country Mortgage, and you find everything online at smartmortgageshow.com. What's happening, Bill?
Hey, Ben, how are you?
Doing well. Good to talk to you again. And got a good question that's kind of spurring this conversation about mortgage rates and getting the best possible rate. Because, listen, I know everyone wants to get the best rate possible. And I know you guys across country help do your best to get them in the best product that fits them, right?
Yeah, so one of our goals is even beyond the best rate possible, what's the best financial situation? So we work with over 100 different banks or investors, as we may call them, and they all offer different interest rates. So we're looking for, let's work with the bank or the investor that has the lowest rate based on your specific criteria. But then there's other factors as well. And, one of them is how much money should I put down in order to get a better rate? And there's some thresholds that we look at there. One of them is putting 3% down versus 5% down on a conventional loan. So if you put down 3% on a specific type of conventional loan, the rate's going to be higher than if you put down 5%. And also the PMI will be higher on 3% down versus 5% down. So in that case, if we can reasonably find the cash without liquidating all your savings, because we don't ever recommend doing that. When we find the big benefits for putting more money down, we will guide you into giving you some options to see what scenario A with 3% down versus scenario B with 5% down, what that might look like.
I think that's important too, because I know a lot of people going into this don't know the right questions to ask just because they haven't done this before, done the experience going through the mortgage process. But again, that's something you kind of work people through and walk them through is okay, here are some options. Okay, if you do this number down, this is what the mortgage rate might look like, or the PMI versus this number. It's not something someone has to ask you to try to pull that information out of you, right? That's something you're going to try to help educate them on.
Yeah, because we always assume that you do this only a handful of times in a lifetime, so you don't know what you don't know. And there's a lot of considerations when we ask the customer what's most important to you. The only thing they really know is it's a loan and there's an interest rate for a lot of people. So then we ask, well, what are your other considerations? And they might say, we don't really have any. And then we say, well, you might want to think about if you put more money down, you might get a better rate. Or here's the other one, Ben. The opposite of that is I think there's too much noise, too much not so great information out there that says put down as much as you can at all costs, right? Because my philosophy and most of my mentors as I've come up in this business, the people that I've learned the most from, the financial minds of people who I think make the best financial decisions, they would say you might not, let's just say you had enough cash to put 50% down.
Yeah.
Well, there might not be a big rate benefit. Now, listen, putting 50% down versus say 20% down, you're putting your money into a good spot. You're putting your money into real estate, which is a good investment. But that 30% disparity there, you might be able to earn 10% in the market. So there's definitely the idea that putting more down isn't always better because of the opportunity cost of what that money could have done in another place.
So there are benefits to putting a larger down payment down, obviously, but one of those is not necessarily a lower mortgage rate, right? If you're deciding between 20% down and let's say 50% down, as in your example, that mortgage rate's not really going to change.
Maybe slightly on a specific day where we're right on the cusp of two different rates, possibly, but for the most part, not really. It's not going to make much difference. Now, one other consideration there, if we have a credit score issue, let's just say when your credit scores are really high, you're getting the best rate pretty much with 20% down or 40% down. Again, maybe on a specific day, a slight disparity. But now let's just say your credit's a 640 and you're on the lower end of the credit ranges, with 620 being the lowest you can do on a conventional. In that case, on that day, you'd probably get a significantly better interest rate if you put more down, because with the lower credit score, they're going to feel like it's a lot riskier, but that risk diminishes with the more money that you put down. So in that case, and again, to your point, the customer doesn't know what they don't know. We're going to give them a compare. Let's show them both. They can compare both and make the best decision.
Yeah, that's interesting. I wouldn't necessarily have thought of that, but it makes a lot of sense. Like, there's a lot of factors obviously go into this. So again, why you rely on someone like Bill at the Cross Country Mortgage that does this every day, that has a lot of experience, and really is not about trying to get you in a mortgage. It's about getting the right fit for you to make sure that you're in the best possible situation financially moving forward to reach the goals that you have, for whether that is your home or your financial future, whatever that is. Cross Country Mortgage can work with you. So again, that kind of answers the question of this video, Bill, but just a couple. I know we've done some videos on this in the past, but just a reminder for people that are looking to get their rate lowered a little bit. There's a couple of things that they can maybe do ahead of time besides the down payment that they can give them a best opportunity to get that best rate possible.
Yeah, so one of the things that we see we can be very helpful with, and it's not always, sometimes it can be a hard thing to affect, but a lot of times it's super simple. Is just your credit card balances not being at the limit, lowering those utilization ratios. What we look for too is when we're looking at your credit, we're going to say, hey, maybe if we pay down a few credit cards, it might be $1,000, $2,000, $3,000, might boost your score 40, 60 points. That can help your interest rate be lower as well. So we're always looking out for all of the potential options, combinations of options, but that one is one that you can sometimes affect change with very easily to get a lower rate.
All right, very good. Well, if you want to learn more or want to begin talking about what rate options are available for you, you can always go to smartmortgageshow.com or text the word LEND to 21,000, and you can get in touch with Bill that way as well to set up a free consultation, begin talking through these things, and he'll begin explaining the process and learning more about you and what you're looking to accomplish. So hopefully this answers the question about down payments and how that affects mortgage rates. But again, if you want to learn more, please get in touch. Bill, thanks as always.
Thanks, everybody. Appreciate it.
This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.